ASC 220 Comprehensive Income, Section 2 of 8 Key Terms and the 4 OCI categories. Welcome back to this explainer. In our last lesson, we established the fundamental purpose of other comprehensive income, or OCI, and exactly why it exists as a separate component. Today, we're going to demystify it even further. We'll see exactly why misclassifying OCI can completely distort a company's financial reality. This is absolutely foundational stuff, so let's jump right in. Here is our roadmap for today. We've got 5 stops: the big picture, core OCI terminology, the 4-stage OCI journey, the 4 OCI categories, and finally, the strict default rule. We're layering this knowledge from the basic vocabulary right up to the strict rules that run the show.
So, starting with Section 1, the big picture, defining the boundaries of comprehensive income. It's time to clear up some major confusion about what actually belongs in comprehensive income versus your standard earnings. Think of comprehensive income as the whole pie. It represents the total change in equity from all non-owner sources. It's really the most complete measure of economic performance we have. But while net income is the slice of the pie everyone is always staring at, the income statement bottom line, OCI is the remaining slice, and it is strictly rule-bound. OCI captures very specific items that explicitly bypass net income. You can't just lump these together in your day-to-day accounting. Understanding the firm boundary between these two is step 1 to getting your financial statements right. Moving on to Section 2, core OCI terminology, the vocabulary of comprehensive income. To actually work effectively with OCI, we've got to master the precise terminology you'll see across every category and disclosure. We already know comprehensive income is net income plus OCI. But where does OCI actually live? Well, it lives in AOCI, or accumulated other comprehensive income. Think of AOCI as a bucket in the equity section of your balance sheet. It's a running, cumulative total of all OCI items that haven't yet been reclassified to earnings. And yes, it can be positive for net gains or negative for net losses. Then we have this thing called the stranded tax effect. Imagine an item is just sitting there in your AOCI bucket, and suddenly the corporate tax rate changes. The tax effect you originally recorded in AOCI doesn't match the current rates anymore, which leaves a weird residual balance behind even after the item itself is gone. That is a stranded tax effect. Thankfully, ASU 2018-02 lets you reclassify that stranded amount over to retained earnings just to clean up the bucket. Now let's talk about the reclassification adjustment. Listen, this is a massive area of risk for accountants. A reclassification adjustment is the specific amount transferred out of OCI and into net income when a certain trigger event is met. Why is this so absolutely crucial? Because it prevents double counting. An item gets recognized in OCI when it first arises, but when that trigger happens, you have to actively move it over to earnings. If you miss this reclassification adjustment, you're leaving the gain in equity and you're recognizing it in your earnings. You'll end up double counting the impact and literally wildly misstating the company's earnings. Nobody wants that. All right, Section 3, the 4-stage OCI journey. Inside the financial waiting room. Let's trace a single generic dollars journey through OCI, and I want you to frame it not as a permanent destination, but as a temporary waiting room. Every single OCI item follows this exact 4-stage path from origination down to 0. Stage 1. It arises. The OCI generating event happens, you debit or credit your asset or liability, and the offset hits OCI, entering that AOCI bucket on the balance sheet. Stage 2. It waits. Our dollar just sits there in the AOCI waiting room between reporting periods. It carries a cumulative balance that gets updated each period, but, and this is key, it has 0 earnings impact while it's waiting. Stage 3. It reclassifies. The trigger event finally occurs. Our dollar is called up to the main stage. You remove it from AOCI and it hits the income statement. Stage 4. Gone. The AOCI balance for this specific item is now exactly 0. The journey is totally complete. It arrived, it waited, it reclassified, and now it's gone. That brings us to Section 4, the 4 OCI categories. The VIP list for the OCI waiting room. So who actually gets to go into this waiting room? We need to emphatically destroy a major myth right here, right now. Let me be absolutely clear about this. No company, no CFO, and no accountant has the power to just choose OCI treatment because they feel like smoothing out their earnings or hiding some volatile loss. No way. Only specific GAAP standards grant that exclusive pass. If the GAAP codification doesn't explicitly designate an item as OCI, it goes straight through net income. Period. End of story. So here they are. These are the 4 VIP categories allowed in the OCI waiting room, and they map perfectly to the strict triggers that force them out of AOCI and into earnings. Category 1, the effective portion of a cash flow hedge under ASC 81530. This one reclassifies when the hedged transaction finally affects earnings. And quick heads up, we are going to be doing a massive deep dive into this exact category in our very next lesson, so keep it in mind. Category 2, foreign currency translation adjustments, or CTA, under ASC 83030. Imagine you've got a subsidiary in Europe, you translate their financials, and the adjustment just sits in AOCI. It only triggers to earnings if you actually sell off that European sub or substantially liquidate it. Category 3, unrealized gains and losses on available-for-sale debt securities under ASC 320-10. These wait quietly in AOCI until the security is sold or until a credit loss is recognized. And finally, Category 4, pension and OPEB adjustments under ASC 715-20. These are your actuarial gains and losses, and they're triggered through a strict amortization schedule straight into compensation expense. Do you notice how structured this all is? Every single category has a specific rule to get in and a specific exit door to get out.
Now, while those four cover the vast majority of entities you're ever going to work with, you should be aware that a few less common OCI categories do actually exist. Things like the effective portion of a net investment hedge, your share of OCI from an equity method investee, or own credit risk on fair value option liabilities. I'm just pointing these out so you know they're out there under very specific ASC rules. But again, they are strictly defined by GAAP. It's never about management preference.
And that leads us perfectly into Section 5, the strict default rule. When in doubt, where does it go? We've covered the terms, we've mapped the journey, and we've met the specific categories, so let's establish the ultimate rule of thumb. Picture this. You're sitting at your desk, and a team member comes up to you with a strange, incredibly complex new transaction. They take one look at the volatility it's going to cause, and they ask, hey, can we just put this through OCI so it doesn't totally wreck our net income this quarter? How do you answer them? The answer is almost certainly, unequivocally, no, unless that team member can open up the codification and point to the exact ASC standard requiring OCI treatment for that specific transaction. It absolutely does not belong in the waiting room. Default to earnings. When in doubt, the default is earnings. To wrap up this explainer, remember that these strict rules govern everything we do with comprehensive income. OCI is not a dumping ground. It's a highly regulated, temporary waiting room with very specific entry passes and strict exit triggers. You should now be able to confidently define the boundaries of OCI, identify its four main categories, and apply that strict default rule to any new transaction that comes your way. So with all that in mind, when you get back to your desk, where will you correctly classify your next tricky transaction?